I was not planning to talk about this today. Then oil moved through $115 a barrel. Physical deliveries in Asia started trading far above the paper price, and I spent the morning reading the kind of institutional note that usually never reaches ordinary investors. That is when I knew this had become dangerous. Not dangerous in the abstract, dangerous in the way a loose wire behind a wall is dangerous. You do not see flames at first. You just smell something burning. Then the whole room goes, if you think this is just another scary headline out of the Middle East, you are already behind. Because every time oil has spiked like this over the last 50 years, something in the financial system has broken. Not sometimes, every single time. That is the part people like to ignore. They want to believe this is a temporary panic, a buying dip, a noisy news cycle, another brief fit of volatility that polite commentators can talk over until the market recovers and everybody goes back to pretending risk is gone. I do not think that is the honest read of the board. And what makes this period even more dangerous is that the assets people expect to protect them are not behaving the way the textbook says they should. Gold is down hard. Silver has been hit even harder. The things people call safe havens are selling off during a war. So now the ordinary investor is standing in the middle of an everything crash, looking at oil, looking at stocks, looking at metals, and asking the wrong question. The wrong question is whether this feels fair. The right question is what mechanism is running underneath the surface. Because once you see the mechanism, the market stops looking random, it starts looking inevitable. And once a thing becomes inevitable, your job changes. You stop arguing with it, you start positioning around it. I have lived long enough to know that investors lose the most money when they confuse surprise with opportunity. Something shocks them, they tell themselves the market must be wrong. They start buying whatever fell the most because it feels cheaper. They do not ask whether the fall is near its end or whether it is only the first forced leg of something much larger. That distinction matters. It matters because oil at these levels is not just an energy story. It is an inflation story. It is a rate story. It is a consumer story. It is a corporate margin story. It is a policy story. And by the time it reaches the market, it has usually become a balance sheet story. That is where fortunes are lost. And if you keep your head while everyone else is reacting to headlines, it is also where fortunes are made. So let me tell you how I would read this if I were sitting across the table from you with your portfolio open and your stomach tied in knots. I would start with the one fact that should make you stop and pay attention. Oil has been one of the most reliable crash indicators in modern market history. Go back to 1973. Oil exploded upward, and the S&P 500 was cut nearly in half. Go to the Iranian Revolution at the end of the 1970s. Oil surged again. Inflation ran wild. Rates had to go to levels that broke the economy, and recession followed. Go to 1990. Another oil shock, another sharp equity decline. Go to the 2000s. Oil climbed for years, squeezed the system. And by the time it peaked in 2008, the broader market imploded. People like to tell themselves 2008 was only about subprime mortgages. That is not how the world works. Systems crack where they are weakest, but stress rarely comes from one source. Oil has a habit of finding every hidden weakness in the machine and pressing on it until something breaks. That is why I never dismiss an oil spike as somebody else's problem. Energy is not a niche input. It runs through transportation, manufacturing, fertilizer, plastics, logistics, packaging, heating, chemicals, aviation, shipping, food, and every business that depends on moving atoms from one place to another. When energy gets repriced, the economy gets repriced. That is what the market is beginning to understand. And if you are waiting for television to explain it clearly, you are giving up your edge before you ever had one. The first move in a crisis is always visible. The second move is usually hidden. The first move here was military conflict, shipping disruption, fear, and a sudden squeeze in the flow of oil. The second move is the one that matters more. The second move is what oil does to inflation, what inflation does to the Fed, what the Fed does to rates, what rates do to stocks, and what forced selling does to everything else. That is the chain. Miss the chain, and every price move looks irrational. See, the chain and the tape starts making sense. Start with transportation. When oil spikes, every truck, ship, plane, and rail system carrying goods gets more expensive to run. That does not stay inside the energy sector. It moves outward. Higher diesel means higher freight. Higher freight means higher landed cost on everything from groceries to machinery. Then producers get hit. Oil is not only burned, it is used. It sits inside plastics, industrial chemicals, fertilizers, packaging materials, pharmaceuticals, and manufacturing inputs that most people never think about until margins start collapsing. Then the consumer gets hit, food gets more expensive, delivery gets more expensive, travel gets more expensive. The ordinary household does not need a PhD in macroeconomics to notice it. They feel it at the pump, at the grocery store, and on every bill that used to feel routine. And when households feel poorer, they act poorer. That is where the market story becomes a profit story. Consumers pull back. Companies that looked fine at last quarter's margins start missing expectations. The market, which had been priced for optimistic growth and lower rates, suddenly has to confront a more expensive world and a weaker customer at the same time. That is the beginning of the squeeze. Now here is where it gets especially ugly. In a normal slowdown, investors hope the Federal Reserve can rescue the situation by cutting rates. That was the dream a lot of people carried into this year. They loaded up on growth, on high-duration assets, on software, on speculative names, and on stories that only work beautifully when money gets cheaper and the discount rate falls. Then oil blew a hole in that dream, because once inflation is being pushed up by energy again, the central bank is no longer free. It is trapped. If it cuts too early, it risks feeding inflation. If it stays tight, it risks cracking growth. If it hikes, it may crush an economy already slowing under the weight of higher costs. That is not a position of control. That is a position of entrapment. And markets can live with bad news longer than they can live with central banks that are trapped. This is why safe havens have not behaved the way people expected. The amateur thinks war means gold up, that is the cartoon version. The real market is more complicated. When rates rise or stay higher than expected, the opportunity cost of owning gold rises too. When the dollar strengthens because investors can earn more in dollar assets, that pressures metals. When algorithms are programmed to respond to higher yields, a stronger dollar. And broken technical levels, they do not stop to ask whether a war ought to be bullish for gold. They sell when leveraged products are piled on top of that. The selling becomes self-feeding. That is the part almost nobody explains properly. A great many investors did not own simple, patient exposure to metals. They owned leverage. They owned products designed to magnify daily moves. Those things feel brilliant in a straight rally. They feel like genius. Gold goes up, your leverage product goes up more, and you begin to believe you have found an intelligent shortcut to wealth. Then the market goes the other way. Now, the same structure that flattered you on the way up begins to punish you on the way down. The holders sell because they are scared. The product has to rebalance because it is built that way. More selling produces lower prices. Lower prices trigger more stress. And before long, what looked like a clever way to express a long-term idea has turned into a machine that destroys you in the short term. Leverage is often just a respectable word for fragility. That is true in business. It is true in personal finance, it is true in portfolios, and it is especially true in panics. I have spent a lifetime watching people confuse conviction with leverage. They are not the same thing. Conviction is what lets you hold a sound position through volatility. Leverage is what prevents you from surviving long enough for conviction to matter. So, if you want to understand why gold and silver are struggling during a war, stop beginning with the safe haven myth and begin with the real sequence. Oil shock, inflation pressure, Fed trap, dollar firm, yields high, algorithm selling, leveraged products rebalancing. Everything liquid enough to sell gets sold. That is how a crisis takes assets that should protect people and turns them, for a while, into sources of pain. But there is another layer to this, and it is the one I find more interesting than the headlines. Wall Street is not merely reacting to the crisis. It is already trying to price the policy response. That matters because the money is rarely made by correctly identifying the problem after it becomes obvious. The real money is made by correctly identifying what policymakers will do once the pain threshold is reached. This is where ordinary investors fall behind. They focus on what is happening. Institutions focus on what the people in power will be forced to do next. And when I say forced, I mean forced, because governments love to sound disciplined right up until the moment discipline becomes too expensive. Then they change language, they change priorities, they change policy, and afterward, they act as if the reversal was always part of the plan. If the market falls far enough, if financial conditions tighten hard enough, if consumer confidence deteriorates far enough, if unemployment starts rising fast enough, the pressure for intervention becomes overwhelming. Call it policy support, call it emergency response, call it stabilization. The label does not matter. What matters is that once enough pain arrives, governments and central banks start looking for ways to absorb it. That can mean de-escalation efforts, that can mean rhetorical shifts, that can mean liquidity support, that can mean direct or indirect measures designed to bring rates down or restore confidence. The institutional note I was reading made this point very clearly, and it is a point most retail investors never see in time. The market is not only pricing the shock, it is trying to run the panic response to the shock. That is why you should never confuse Phase 1 with the whole event. Phase 1 is the hit. Phase 2 is the response. Phase 3 is the rotation into what benefits when the response becomes real. Most people lose in Phase 1 because they are emotional. Most people miss Phase 2 because they are exhausted. Most people arrive in Phase 3 because the headlines finally told them what already happened. I would rather you not be most people. Let me say this even more plainly. When oil spikes this hard and this fast, there are only so many ways the story can develop. Either the shock fades quickly, shipping normalizes inflation expectations, cool, and the market stabilizes before something larger snaps, or the shock lingers, inflation embeds itself more deeply, financial conditions tighten, and policymakers are forced into some form of intervention. In either case, blindly reacting is foolish. You need a framework, and the framework begins with survival, not excitement, not cleverness. Survival. Phase 1 is about not doing the stupid thing. That sounds too simple for people who enjoy complexity, but it is true. Do not blow up a sound core portfolio because the news is frightening. Do not chase oil after the move has already shocked the world. Do not pretend you can time every headline out of a war zone. Do not keep leverage that can bankrupt you. Do not hold positions so large that a normal crisis move turns you into a forced seller. If you cannot survive Phase 1, the later opportunities do not matter. This is why I have always preferred the investor who can stay in the game over the investor who talks the loudest about upside. The first rule of compounding is not elegance, it is endurance. Now, once you have survival handled, the next question is what will matter if policymakers panic? The answer is not everything. In fact, a great many things that people want to buy in a crisis are already crowded. Defense names often move early. Energy names often move early. The obvious trade is usually obvious because the first leg already happened. I do not like arriving late to what everybody already understands. I prefer looking at what has been damaged, what can recover if conditions ease, and what the money begins to favor before the headlines admit the turn. That is why some of the most interesting areas in a market like this are not the ones that feel emotionally satisfying. They are the ones that got beaten down by tightening conditions and can respond sharply if those conditions loosen. Consumer discretionary is one of those areas, not because households are in a wonderful mood, they are not, but because pessimism there can become excessive when the market begins to price a world in which consumers are broken. Some consumer names trade as if no recovery is possible. History says that kind of blanket pessimism can create opportunity, especially when policy starts shifting and financial conditions begin to ease. Software is another area worth watching. A lot of software names were priced for an easy money world, got punished when that world vanished, and then got punished again when rate cut hopes faded. That does not make every software company attractive, far from it. But it means you should know the difference between an unprofitable fantasy and a durable business that got marked down because the entire group was de-risked. Consumer finance also belongs on the list. If rates peak, if the market starts pricing relief, if policy intervention lowers the pressure on borrowing costs and credit conditions, these names can move. Not because the economy becomes perfect, because the market had priced them for something worse. I am not telling you to buy anything merely because it fell. That is how amateurs talk. I am telling you to understand the relationship between falling prices, policy pressure, and the timing of money flows. A stock is not cheap because it hurts. It is attractive when the downside has been recognized, the balance sheet can survive, and the conditions that cause the compression begin to ease. That is a very different standard, and it is the standard that keeps you from buying broken merchandise and calling it value. Now let me turn back to gold, because people are going to misunderstand the point. If I do not say it carefully, a violent correction in gold does not automatically mean the long-term case is broken. In many cases, it means the short-term structure is stressed. Those are different things. If the present weakness in metals is being driven by higher yields, dollar strength, algorithmic selling, leveraged product rebalancing, and indiscriminate liquidation, that tells you something important. It tells you the decline may be a structure story before it becomes a thesis story, and structure-driven declines end when the structural selling exhausts itself. That does not happen. because you want it to. It happens when the pressure runs out, when the dollar weakens, when the Fed is forced to change tone, when real rates begin to soften, when panic selling finishes its work. Then the long-term reasons people own gold in the first place come back into view. Currency weakness, monetary dilution, policy rescue, loss of confidence in paper promises. That is why I never like drawing a straight line from short-term pain to permanent validation. Markets are not that simple. A lot of money gets made by distinguishing between a thesis that is wrong and a position that is early. Those are not the same. What I would not do is express a patient idea through impatient instruments. That is how people turn a sound macro view into a personal disaster. If you want exposure to something volatile, do not structure it in a way that guarantees you will not survive the volatility. I have watched investors destroy years of good decisions with one bout of impatience. They wanted more upside. What they got was less staying power. There's another reason I take this setup seriously. When the mainstream commentary tells you to stay calm without explaining the transmission mechanism, it is usually because explanation would force them to admit how fragile the present arrangement is. A market price for lower rates does not want to hear that oil can keep rates high. A public fed on optimism does not want to hear that inflation can return through the side door. A generation trained to buy every dip does not want to hear that some dips are liquidation events before they are opportunities. But if you have capital to protect, wanting comfort is not a strategy. Clarity is a strategy. And clarity begins by admitting that this may not be a quick V-shaped inconvenience. That possibility matters because if you assume every shock resolves like the most recent one, you will eventually meet the shock that does not. That is how costly lessons get taught. This one has a more structural feel to it, not because I enjoy dramatic language, because when physical oil trades far above paper oil, when shipping is genuinely impaired, when inflation risk rises again, when the Fed's freedom narrows, and when liquid assets across the board are being sold for cash, you are no longer watching a passing scare. You are watching stress move from headlines into plumbing. And whenever stress reaches plumbing, I pay close attention. That is the zone where risk management matters most. So let me tell you what I would write down. If this were my own household and not a public conversation, I would keep the core. I would know exactly where the fragility sits. I would eliminate leverage I do not need. I would avoid dramatic all. In shifts, I would not chase what already ran. I would study the sectors that benefit if policy panic emerges. I would be patient with metals if my exposure is structured sanely, and I have the time horizon to deserve the eventual upside, and I would watch money flows rather than giving my emotional life to headlines. That last point matters more than people realize. The average investor thinks information means more news. Usually it means less. A person who spends all day absorbing emotional headlines starts thinking in headlines. A person who studies where capital is moving starts thinking in odds. I prefer odds. Odds do not eliminate uncertainty. They make it survivable. And survivability is what lets you be there when the turn comes. The strange thing about markets is that the big opportunity often looks worst right before it becomes obvious. People want the all-clear siren. They want the authorities to ring a bell and announce that risk is gone and upside is now officially allowed. That never happens. By the time the all-clear feeling arrives, price has already moved. That is why waiting for emotional comfort is so expensive. The easy money is gone by then. You are paying for certainty, and certainty is the most overpriced asset in every market. If policy panic arrives, if rates begin to soften, if the dollar weakens, if inflation fears and growth fears force officials into a response, then the things that were crushed under tight conditions can rebound fast. That does not mean buy recklessly. It means prepare before the move becomes respectable. That is the difference between reacting and investing. I know a lot of investors want a simple answer right now. Sell everything, buy the dip, hide in cash, go all in on oil, go all in on gold. That is not how serious money is managed. Serious money is managed by understanding phases. In phase 1, you protect yourself from becoming collateral damage. In phase 2, you identify what policy rescue would help most. In phase 3, you let the profits come from being positioned before the crowd catches up. It is slower, it is less entertaining. It is also how people keep their capital. And capital, once lost badly enough, stops being abstract. It becomes time, it becomes options, it becomes peace. That is why I speak to you this way in periods like this. Not because I enjoy fear, because I have seen what happens when people mistake a dangerous market for a democratic one. The market is not democratic. It does not care how badly you want it to bounce. It does not reward hope. It rewards discipline. It punishes fragility. It transfers money from emotional hands to prepared hands with brutal efficiency. So if you want one simple sentence to carry with you through this period, take this one. Do not die in phase one. Most investors who will lose serious money here are not losing it because they were incapable of understanding the macro story. They are losing it because they were overexposed, overleveraged, overstimulated by news, and structurally unable to survive the volatility. That is not a forecasting error. That is a preparation error. Fix the preparation, and the range of outcomes changes immediately. Then, once you have done that, you can start looking calmly at where the future reward may sit. Maybe that is in metals after the liquidation exhausts itself. Maybe that is in selected international exposure. If the dollar weakens, maybe that is in battered discretionary software or finance names if policy support materializes. Maybe that is in businesses with real pricing power and strong balance sheets that can live through inflation and emerge stronger on the other side. What it is not in, at least in my experience, is panic. Panic feels active. It feels righteous. It feels like doing something. Usually it is just expensive. I would rather own fewer opinions and better rules. That is how I have always tried to operate. People think investing is about finding the exciting thing first. A lot of the time it is about refusing to do the stupid thing while everybody else is performing urgency. Urgency is contagious. That is why rules matter. Write them before the tape gets uglier. Decide what you will not do. Decide what level of loss would force a reassessment. Decide which positions are core and which are speculative. Decide how much cash you need to remain rational. Decide what signs would tell you policy panic is forming. Decide which sectors deserve a watch list and which ones only deserve gossip. Then when the market gives you another violent week, you do not have to invent a personality under pressure. You already have a framework. That is what separates the investor who survives from the investor who becomes a story. And let me leave you with the part that matters most. The world looks unstable right now because it is unstable. The oil market is signaling stress. The rates market is signaling stress. The behavior of metals is signaling structural liquidation. And policymakers are moving closer to the zone where they will be pressured to respond. That is not the end of the game. It is the beginning of a more serious one. In every cycle, there comes a moment when the average investor is forced to choose between two identities. The first identity wants comfort, simplicity, and the permission of the crowd. The second identity wants clarity, patience, and the ability to act before the crowd feels safe. The first identity usually buys headlines. The second identity usually buys time. Time is what compounding needs. Time is what flexibility needs. Time is what lets a good decision work. So do not ask me whether this week was scary. Of course it was. Ask whether the fear is making you sloppier or sharper. Ask whether you own things that can survive. Ask whether your portfolio requires the world to calm down immediately. Ask whether your exposure is structured for your time horizon rather than your adrenaline. And ask yourself one last question before you touch anything. Are you trying to get through a crisis with rules, or are you trying to get through it with feelings? That answer will determine far more of your outcome than the next headline ever will.